What if the most important shift in the global financial system has been happening quietly, right in front of everyone, for over a decade? October 2025. China holds $688.7 billion in United States Treasury securities. Now rewind 12 years to November 2013. That number was $1.316 trillion. The difference matters. It is over $627 billion of American debt that China has steadily and quietly sold off, not in a dramatic exit, but in a controlled unwind that avoids panic. Before we go further, if this kind of calm, math-driven breakdown helps you see what headlines miss, stay with me here, and make sure you follow this channel, so you do not miss what comes next. These patterns only become obvious once you know where to look. Here's where it gets interesting. Over that same period, China's official gold reserves rose from roughly 1,054 tons to 2,303 tons. At the same time, China became the world's dominant silver buyer, consuming massive quantities through its solar panel industry alone. On the surface, you might think this looks like routine portfolio rebalancing, just standard central bank behavior, but it is not standard. This is a pattern, and it is one that shows up in every major currency collapse across recorded history. Once you recognize it, you cannot unsee it. Here is what is actually at stake. The global financial system runs on $36 trillion of U.S. federal debt. In 2024, interest payments alone reached $1 trillion. Pause on that. Interest, not principal, now costs more than the entire U.S. defense budget for the first time in history. As of December 2024, foreign central banks hold $8.5 trillion in U.S. treasuries. The dollar also backs $73 trillion in derivatives. Oil, grain, medicine, microchips. Almost everything settles in dollars. This is not just large. This is the core architecture of how global trade functions, and the second largest holder of this debt, after Japan, has been selling for more than a decade, while buying gold and silver. So the real question is not whether China believes in America. The question is what China understands about systems like this. They have seen this movie before, not just in their own 5,000-year history, but in the rise and fall of every empire that believed its debt was different and its currency permanent. China is not betting against America. China is betting on the pattern, and that pattern has never failed. To understand this, you need to see the structure. There are 4 stages, and they appear in every currency collapse throughout history. Once you understand the structure, you will start recognizing it everywhere. In ancient Rome, in revolutionary France, and unfolding right now. Stage 1 is the foundation. A nation emerges from war, crisis, or chaos with a currency backed by something real. It might be gold, silver, land, or simply unmatched credibility from being the last power standing. That backing creates trust. Trust creates demand. Demand turns the currency into a reserve currency. People hold it because it represents something solid. Look at the British pound. It was backed by the largest navy on earth, the biggest empire in history, and the gold reserves of the Bank of England. Or take the US dollar after Bretton Woods in 1944. It was not just backed by industrial strength, it was directly convertible to gold, at $35 per ounce, locked in by treaty. Foreign governments held dollars because dollars were literally as good as gold. You could exchange paper for metal. That was not a vague promise. It was a contract, enforced by gold bars. Stage 1 anchors belief. Trade expands. The global system reorganizes itself around that currency. The issuing nation gains what economists call exorbitant privilege, meaning it can print money that the rest of the world must accept. They need it for trade. You use it for spending. As long as the backing holds, the system works. The issuing country spends beyond its means. The world gets a stable medium of exchange. Everyone benefits, but embedded in stage 1 is the seed of collapse, because it leads directly into stage 2, expansion through debasement. The issuing country realizes it can print more money than it has backing for. At first, it is modest, funding a war, building infrastructure, supporting social programs to maintain stability. Money flows out faster than the gold or silver behind it can support. Under Bretton Woods, the United States began running persistent deficits in the 1960s. Dollars flooded Europe and Japan to fund Vietnam, the Great Society, and a global Cold War military footprint. By 1971, there were far more dollars in circulation than could ever be redeemed for gold, at $35 an ounce. The backing ratio collapsed, but spending did not slow, it accelerated. Here is why stage 2 is so dangerous. Stopping causes immediate pain: recession, unemployment, political upheaval. Ending the programs that kept social order intact. Continuing causes inflation. But inflation can be exported to everyone holding your currency. Every reserve currency nation chooses to continue. Every time. Look at Weimar Germany in 1922. After France and Belgium occupied the Ruhr over unpaid reparations, the German government paid striking workers by printing marks. The money supply exploded. In January 1922, the exchange rate was 180 marks to the dollar. By December, it was 7,150. The government knew. Economists warned them. They printed anyway. Because stopping meant political collapse. Stage 2 is not an accident. It is a rational decision, under pressure. But it is also irreversible. Once backing breaks and debasement begins, there is no return path. The temptation is too strong. The political cost of austerity is too high. Printing continues until it cannot. That brings us to stage 3, loss of control. This is where we are now. And this is the stage China is navigating, with cold precision. Eventually, the largest and smartest holders of your currency see the math. They understand debasement is underway, but they do not announce it. They do not dump assets overnight, because that would destroy the value of what they still hold. Instead, they diversify quietly. They reduce exposure. They rotate into assets that do not rely on anyone keeping promises. Gold, silver, strategic commodities, other currencies, and outside the system. And they do it slowly enough to avoid panic, but consistently enough that anyone watching the data knows exactly what is happening. China held $1.316 trillion in U.S. treasuries in November 2013. Today, that figure stands at $688.7 billion. That is a 47.7% reduction over 12 years. To put scale on it, in 2022 alone, China sold $173.2 billion. In 2023, another $50.8 billion. In 2024, another $57.3 billion. And 9 out of 12 months in 2024 showed net reductions. If this kind of breakdown helps you see patterns instead of headlines, stay with me and make sure you follow this channel. Understanding this early changes how you see everything that comes next. This is not portfolio management. Portfolio management rebalances. It moves in both directions. This moves one way. This is an exit strategy, executed slowly enough to avoid triggering panic or collapsing the value of what China still holds. So what are they replacing treasuries with? Gold. The People's Bank of China added gold for 11 straight months through September 2025. Official reserves now sit at 2,303 tons, but analysts tracking physical gold flows through London and Shanghai believe China's real holdings may exceed 5,000 tons. That would put them ahead of every country, except the United States. The gap between official reporting and physical flow matters, because it suggests accumulation without disclosure, which is exactly how large players move when they want discretion. China is also dominating the silver market. They are the world's largest consumer, and a major driver of demand comes from solar panel manufacturing. China controls most of global solar production, and every single panel requires silver for conductivity. This is not optional usage. It is structural demand. Silver has gone parabolic. In 2025 alone, it is up over 120%. It is trading around $67 per ounce, an all-time record. In 2024, the global silver market ran a deficit exceeding 200 million ounces, and analysts expect that deficit to persist through 2025. Supply is not keeping up. China is not speculating. They are accumulating physical metals that have preserved purchasing power through every monetary collapse in history. This is stage 3. The smart money exits quietly. The reserve currency nation continues borrowing and printing, reassured by the fact that bond auctions still clear. What is missed is who the buyers now are. Domestic buyers, pension funds, banks required by regulation to hold government debt. These institutions are not choosing freely. They are constrained. Foreign central banks, the ones converting real production into paper claims, are stepping back, not to cause destruction, simply because they refuse to be the last holder when the math turns unforgiving. And that leads to stage 4, the breaking point. This is where mathematics overwhelms politics. Interest payments grow so large that funding the government requires issuing more debt. More debt requires higher interest rates to attract buyers. Higher rates raise interest costs, which require still more debt. The loop feeds itself. The currency stops functioning as a store of value. Inflation accelerates. Real interest rates fall below zero. Foreign governments and corporations move into assets that do not depend on promises. Trade partners begin using alternative currencies or direct barter. The reserve currency, once the backbone of global commerce, is exposed for what it always was underneath confidence, a liability issued by a government that cannot fully honor it. This already happened to Weimar Germany. In November 1923, $1 bought 4.2 trillion marks. Trusted money turned into waste paper in under 2 years. Savings vanished. The middle class was erased. Hunger riots spread. Political extremism followed, reshaping the world. It happened to the British pound. Before World War I, sterling was the global reserve currency, backed by gold and empire. 2 world wars, the collapse of empire, and refusal to accept diminished power led to the 1967 devaluation. By 1976, the United Kingdom required an IMF bailout. Today, the pound holds under 5% of global reserves. Its dominance is history. It happened to the dollar's gold backing. On August 15, 1971, President Richard Nixon closed the gold window. Foreign governments could no longer exchange dollars for gold because there was not enough gold left. The Vietnam War, the Great Society, and the Cold War had been financed by printing far more dollars than could be redeemed. In May 1971, West Germany abandoned Bretton Woods. In August, France sent a warship to collect its gold. On August 11th, Britain requested $3 billion in gold from Fort Knox. The run had begun. Nixon ended convertibility. The dollar became fiat, backed only by the promise that taxes would be accepted in it. Gold was $35 an ounce. Then, today, it is over $3,000. That represents a 98% loss in purchasing power against the one asset that requires no promise. Now, map the pattern onto today. Stage 1. Bretton Woods, 1944. The dollar became the reserve currency, backed by gold, and by being the only major economy intact. After World War II, real foundation, earned confidence, check. Stage 2. Gold backing abandoned in 1971. Federal debt expanded from $398 billion to $36 trillion. Debt to GDP rose from 33% to 123%. The Federal Reserve balance sheet grew from under $1 trillion in 2008 to over $7 trillion at its peak. Real wages stagnated, while asset prices exploded, creating the widest wealth gap since the robber baron era. Debasement complete, check. Stage 3. Diversification. China has cut treasury holdings nearly in half. Japan sold $27 billion. In December 2024 alone, central banks added over 1,000 tons of gold for 3 consecutive years through 2024, led by China, Turkey, India, and Poland. These are not trades, these are strategic exits. Check. Stage 4. Not yet. But the pressure is visible. Interest on national debt exceeded $1 trillion in 2024, more than defense spending. The Congressional Budget Office projects interest costs will reach $1.7 trillion annually by 2034 under current policy. That alone would consume over 20% of federal revenue. To finance this, the Treasury has to issue more debt. That part is straightforward. But to sell that debt, without the Federal Reserve openly printing money, yields have to rise. Higher yields make the bonds attractive, but higher yields also raise interest costs. Higher interest costs force the Treasury to issue even more debt. That loop feeds itself. This is the spiral. It has not hit terminal velocity yet, but the direction is locked in. Every serious simulation, every debt model that is not designed to comfort politicians reaches the same endpoint. The current path cannot be sustained. The math fails, and the math does not negotiate with elections, narratives, or ideology. This is usually where the optimists step in. They say America is different. The dollar has unbeatable network effects. There is no alternative. The world needs dollar liquidity to trade, so demand is permanent. They point to American exceptionalism, technological leadership, military reach, and the depth of U.S. capital markets, and they conclude, confidently, that this time is different. But that argument is not new. It was made about the British pound. In 1945, it was made about the gold-backed dollar. In 1970, it was made about the Weimar mark. In 1921, in every case, the story sounded convincing, right up until the math overwhelmed it. This time is not different. This time is the pattern. The mechanics do not change. Only the speed and the severity do. Here is what makes China's approach so simple and so effective. They are not predicting collapse. They are preparing for the pattern to finish. If the dollar somehow defies mathematics and remains the permanent global reserve currency, China still holds gold and silver that preserve purchasing power. Nothing is lost. If the pattern completes the way it always has, they hold the assets that become the base of whatever system replaces it, while others hold paper claims on a debtor that cannot pay. That is not speculation. That is risk management. At the highest level, it is what you do when you understand that currencies are temporary, but gold and silver persist across every system that replaces them. So what does this mean for you? It means understanding the machine you are living inside. Reserve currencies do not last forever. Monetary systems do not evolve through polite meetings. They evolve through breakdown. This pattern is older than any modern government and more reliable than any forecasting model. Ask yourself one question. If the largest and most sophisticated institutions on Earth are quietly shifting reserves from dollars to gold, from paper claims to physical assets, why would you ignore that signal? Central banks see the same data you do. They read the same economists, they run the same projections, and they are acting calmly, steadily, without announcements or drama. China is not attacking the dollar. China is reading the pattern. And the pattern says, Stage 4 is inevitable, not necessarily today, not necessarily next month, but with the certainty of a debt spiral that cannot be stopped without pain, and no democracy willingly votes for that pain. When the shift happens, the speed will shock people. Weimar collapsed in under 2 years. The pound lost reserve status in a decade. The gold window closed in a single afternoon. The transition from Stage 3 to Stage 4 is not gradual, it is a threshold. Once crossed, the old system does not reform, it ends. This pattern does not care about your politics. It does not care about optimism. It does not care what you believe. It is mathematical, and mathematics does not compromise. History has already answered whether this happens. The only open question is whether you see it early or whether you are left holding paper when the music stops. China has made its decision. Hundreds of billions moved from treasury bonds into the oldest money humanity has ever trusted. Gold, valued for 5,000 years. Silver, used as money. Before history was written, they are not guessing. They are acting on a pattern that has never failed. Stay with this channel, because what comes next matters more than most people realize. In the next video, we will break down how this system was built, who designed it, why failure was baked in from the start, and what that means for the monetary reset ahead. The pattern is not theory, it is history, and history does not repeat perfectly, but it rhymes. Right now, the rhyme is getting loud. Do not be the one who ignores it. When Stage 4 arrives, understanding will not protect you. Preparation